Hi, everyone. Welcome to our intermission webinar. Today, we're bringing back certified financial planner, Jason Perez. He recently did a webinar with us on Medicare, and you can find the recorded webinar on our website along with the past webinars at wrpioneers.org/intermission. Today, he will break down retirement funds, 401ks, and give you practical tips to avoid common pitfalls and making the most of your options. I also want to invite everyone to follow us on Instagram at WR Pioneers to stay up to date with Pioneers Assistance Fund and Intermission. And Jason, thank you for being here with us today. And if you have any questions for Jason, you can go ahead and enter them in the Q&A box. And I'll go ahead and hand it over to you.
Thank you so much. Well, hello, everybody. Again, I am Jason. I'm happy to be presenting again with you guys, and hopefully today's topic lands home and we're able to walk away from it with just a lot of understanding around 401ks and what your options may or may not be, as well as some alternatives if you don't have a 401k available to you. So let's go ahead and jump in. I have a lot of content and a few slides to check out. All of these slides will be available to you after the fact, as well as on the replay on the YouTube channel. So no need to take notes if you don't want to. You will have access to these, and those will be out in the next several days to you. All right, I'm going to go ahead and share my screen here, and let's just go ahead and get started. So as you guys know, today's topic is everything about your 401k. And we're going to go for it just slide by slide. I'm going to kind of cover the different slides. I'm going to give my my kind of comments and information along with what is on the slides. So feel free, if I do miss something, or if you do have questions, use that chat box to enter your questions in. We will get to them at the end of the session, and I'll be able to answer all of those. So feel free. I'd love to get to all of those. So go ahead and enter those in as you have them. All right. So first off, what is a 401k? It's really breaks down to three components. It's a retirement savings plan that has tax advantages, and that you can invest, that you can choose investments to hold inside of the plan. So really the retirement savings plan part, it's the employer-sponsored plan that allows you to put your pre-tax income towards your retirement savings. So this is something that comes directly out of your paycheck. There's a little bit of a deduction. You elect how much you want, whether it's a percentage or a fixed dollar amount, and that comes out every single paycheck and goes automatically into your retirement savings plan. Now, the tax advantages are really great, actually. So when you contribute into your 401k, that comes out of your paycheck pre-tax. So that year, you're not paying tax on that money. You're actually getting a deduction. You're getting a reduced income level because you're making this contribution. So that means you're paying less taxes in the year that you contribute.
Hey,
now,
Jason, we're not
go ahead.
seeing your slides at the moment. Just wanted to make sure that they're up.
How's that? Can you see that?
Not yet. I've seen your slides. I know they're great. So that's why I want to make sure that we can all see them.
Okay, let me see here. What's happening? What is it that you do see? All right, restarting it. Here we go. How's this? Can you see the slides now?
There we go. We're back.
Okay, perfect. All right. Thank you so much. All right. So like I said, here's a slide that I was talking on. So it breaks down into the retirement savings plan, the tax advantages, and the investment growth. So the tax advantages, as I was mentioning, those are your contributions go into the plan straight from your paycheck. That comes out pre-tax. So that money sits in this account and it grows if you're invested, tax deferred. And then when you take it out in retirement, you end up paying tax at that time. So you're not paying tax now. And in retirement, depending on how much you take out, you'll pay income taxes then. Every 401k also has investment options. So you can take your contributions and you can invest them however you like. There's a lot of different options. We're going to talk about that in just a second, but every 401k does have different investment options that you can choose. Now, I'm going to go ahead and talk more generally than specific because everyone watching probably is in a different 401k, and no 401k is truly the same in terms of the specific investments or any company matching. So I'm going to talk about it generally. So you may or may not have these available to you. And I'm going to try and mention what is in all 401ks versus what may be in your 401k or may not be. So first of all, how does the 401k work? You make your contributions, you can choose your investments, and then in retirement, we take our distributions. So our contributions, essentially, you elect a deferral percentage that could be 1%, 20%, 50% of your income to go out of your paycheck and into your 401k. That's called your employee contribution, and you can elect what you want that percentage to be. Now, there's also potential, and this is not untrue in every single 401k, but there is also the potential for a company match. That's an employer contribution. So if you contribute up to a certain percentage in some 401ks, your company may match your contribution. It could be dollar for dollar, it could be 50 cents on the dollar, but there could be potential that the company makes a contribution if you make your own contribution. So you got to ask, is there a company match? And if there is, find out what that percentage is. And I'd recommend at least making sure your deferral percentage is the percentage that the company will match on. It's just like essentially free money, and you don't want to leave that on the table. Now, when it comes to the investments, in your 401k, sometimes you'll have the difference between, a few different options. Usually there's about 5 to 15 different mutual fund choices, and you can elect how you want your contributions to be divvied up. So some 401ks, rather, I should say, most 401ks have what's called a target retirement date fund. It might be something like Target Retirement 2040, Target Retirement 2060. You got to figure out when about your retirement date is, and you can invest in one of these target retirement date funds. And that's going to give you automatic diversification. The investments that are held within that mutual fund likely have different asset classes like stocks, and it has bonds, and it might have international. So it's going to be managed on your behalf. It's kind of the one stop for your target retirement date. The other option to go is to choose your own investments. So sometimes, aside from the target retirement date, you might have a difference between, several funds that you can choose from. You can elect different percentages, allocate into these funds, and you can choose things like stock funds or a mutual fund that focuses on bonds. If you're a little more investment savvy, that might be a great way to go for you. If you're not, if you're kind of just looking for that turnkey, stick with the target retirement date funds, because those have that built-in diversification. Now, when you are invested in these, any growth that you see grows tax deferred. So you're not paying taxes when the money is inside of the account and when it's growing. Again, when you go to take money out in retirement, the dollar amount that you take out in that year is just going to be taxed as normal income. So there's a lot of good tax benefits for having investments and saving inside of your 401k. Now, distributions, that's kind of the last part. Once you are done working, you're in retirement, you want to start living off the money that you've saved, you can, after the age of 59 and a half years old, start taking your money as you please in retirement. When you take a distribution, that's going to count towards your taxable income in that year. But if you need 10,000 or 100,000, whatever that dollar amount is to live, that is your retirement. We're saving now so that we can retire and we can pull from those savings later on. Now, there is an option before 59 and a half years old. There's two options if you need money, right? Let's just say there's the first option. There's kind of an emergency. You need funds. It's not something that you have cash outside in savings. You got to take some kind of distribution from it. The two options are, number one, most 401ks offer a loan option. You can actually borrow against your 401k value. And in doing so, it's something you have to pay back over time. You'll pay monthly as time goes on. There is an interest rate associated with that. It fluctuates. So you have to ask your specific 401k, if you have loans, and also what the terms would be. So you can borrow against your 401k in most situations. The other option is to take an early withdrawal. So if you're before the age of 59 and a half years old, you can actually take a withdrawal from your 401k. It's a premature withdrawal, so there is going to be penalties, and I'll talk about that in just a second. It's not ideal, but it is available for you if you did, in an emergency situation, need to get money. There's two ways to take money out of your 401k. One thing I want to talk about is the idea of starting early, staying invested in all the different markets, good markets and bad markets, and the effects of compound interest over time. Now, it's often attributed to Albert Einstein, but also people say maybe Warren Buffett said it. So I don't exactly know who initially said it, but the quote goes, compound interest is the most powerful force in the universe. And it really, really is true. So this link right here, and again, you're going to have access to these slides. This link is a really good calculator. These guys don't have any product that they're selling or anything like that. They have a lot of different retirement planning calculators. This one's a great one because you can kind of see how the impact of saving money and time and investments grows that money. So let's just take a look at this this calculator here. So let's just imagine that, let's say, so I am actually 41 years old, and maybe I want to retire at 70. I love what I do. So I have 30 years left that I'm going to work. I have a rate of return. Let's just go something middle of the road. I'm not really aggressive. I'm not really conservative. Let's just imagine that I'm going to go in kind of a moderate portfolio. 6% is very, very reasonable rate of return. You can go 12%, but the chances of you getting 12% consistently is on average is pretty slim. So if you're conservative, maybe focus down on the 4%. If you're aggressive, young, maybe go up to 7%. 8%. I wouldn't go much above that because it becomes unrealistic. Now, let's just say I haven't saved anything up to this point, and I could put in $500 a month. Inflation's about 3%. It's a little high right now. It's a little above that, but on average, over a long period of time, it's about 3%. So here in the blue section, that's what I've saved. So over that 30-year period, I've saved a total of $285 because there's some inflation. It's not a round number, but $285,000. Yeah, go ahead.
Sorry, I don't know if you're showing them the bankrate.com, but it's not showing on the screen.
Well, it's not showing. Why is it not showing? Okay. Thank you again.
Yeah.
Is it showing anything? Is it me or?
It's your presentation showing.
Showing the presentation. Okay.
Mm-hmm.
Let me get back to that. And I see. Okay, there we go. Can you see it now?
Yes.
All right, so I'm going to go back through. Here's that 30 years because I have some retirement, some working still left in. Rate of return, that's how much I can do per month. And you can select and slide these. It's really a nice setup. And then here we go. So when I put my inputs in, I look at this and I say, okay, over the time, the 30-year period, I have $285,000 that I've just contributed, right? So just me putting in over time, and it's not a round number because we have some inflation, so it's calculating for inflation, but I put in $285,000 out of my paycheck from my own income and my savings. Now, simple interest is just the percentage you make on top of what you saved, right? So this green section here is all the simple interest that's accumulated. So that's why we want to get it invested, right? We have our initial savings, and then we have interest and growth that's earned on our savings. So that's what that simple interest is. Now, when you look at this purple section, compound interest, that is interest that is earned on top of the interest. So not only am I saving money, that money is also making money because it's growing over time, but then also that simple interest is earning money. And that's where you see this little purple, it starts to look like a ski ramp. So when I just put in a total of 285,000 of my own money, because I am investing it and because I'm investing over a long period of time, I have a total of $680,000. This is a projection, of course, but around $680,000 that at retirement, I'll be able to use for my retirement. Now, let's just imagine, I'm going to go back up. Let's just imagine I was really smart and I did this 10 years ago. So 10 years ago, I started putting in 500. So let's go with 40 years. Now take a look at what's happened. You see how, again, my savings is pretty linear. It doesn't really ramp up. The simple interest, it starts to really have that ramp, but you can see where that compound interest, it's a force because it just continues. It becomes now the largest component of these three options, right? So my compound interest has earned a total of almost 550,000, 560. And my simple interest and how much I put in is even less than that. Now, let's just imagine I was really smart at 20 years old. I just thought, okay, I'm going to put in $500 a month. You can really see the effects. The longer you can get invested, AKA start early, the more compound interest is going to benefit you if you're invested and you have that time horizon. So the idea with this is to get invested as early as possible because compound interest is really, really going to work in your favor. The longer you have, the more effect you'll end up with. So it's really, really crucial. If you have the option, get invested and stay invested. Get in the market, start putting away. Even if it's a little percentage, you can increase that over time. The idea is to get invested, and this is a great way to do it. Your 401k is a really good tool to do that. Now, let me talk about a couple different details on all 401ks. Number one is contribution limits. You can put for 2023 up to $22,500 if you're below the age of 50. That's the max you can contribute to your 401k. You can, of course, contribute less than that, but you can't contribute more than that. It's just a ceiling. If you're older than 50 or older, I should say, you can contribute up to $30,000 for 2023. Every few years, this will increase just by a little bit. So that number is kind of a moving target just to kind of accommodate for, cost of living adjustments, inflation, things like that. But for 2023, those are the numbers that you can contribute. So you want to elect your percentage so that, of course, you're not going over that. Your 401k actually shouldn't let you go over that. As soon as you reach that number, it'll actually stop taking money from your paycheck so that you don't go over. All right, now we did talk about the possibility of loans. Be sure to ask in your 401k if you do need some money. There could be the potential for taking a loan in an emergency situation. I don't recommend doing it. If you have other resources or if you could avoid taking it, this would be something that I would maybe save for just those emergency situations. And consider taking the smallest possible loan if you have to. You're going to pay that back and you're also going to pay an interest rate. So it does work against the idea of saving and growing your money, because when you take that loan, you're going to pay that interest and it becomes, kind of counterproductive to what your objective is. Distributions, when you go to take money out of your 401k, you can do so. So starting at 59.5, most of us might probably work longer than that, but at 59.5, you have the option to begin taking distributions from your 401k penalty-free, right? We talked about premature distributions, but penalty-free, you can take out money from your 401k at 59.5. Now, when you do take money out, those distributions will be taxed as regular income in the year it was taken. So let's just imagine I'm retired. I take out $50,000 just because I need to pay my bills and live. I'm going to have $50,000 added to my taxable income for this year. That's just how it works. I haven't paid taxes, income taxes, and I haven't paid capital gains on any of the growth. But now that I'm in retirement, if I take out some money, that's just going to count as income tax. That's going to count as income, and then I'm going to be tax income rates on that. Now, premature distributions, those are the early distributions. Now, you are able to take out money before 59 and a half. This isn't, I'm talking about the loan. I'm talking about just purely taking money out of the plan. You can do so, but you are going to pay a 10% tax penalty on the amount of the distribution, plus you're going to pay income taxes on the amount of that distribution. So it's available to you, but you do get penalized to do so. Again, it's one of those things. This is a plan for your retirement savings. It does give you options to get money and borrow money from it, but it's not ideal. The idea is to keep that invested and try not to get into a situation where you would need to take an early distribution or the possibility of taking a loan. All right, so now, again, I talked already a little bit about the available investments, but I want to talk a little more about the diversification of it. If you aren't choosing that target date fund, which has the diversification built in, you want to make sure that you choose your investments or the mutual funds that are available to you based on your risk tolerance and your investment goals. So let's talk about risk tolerance first, just for a second. Risk tolerance is essentially how much fluctuation you're comfortable with in your 401k. So if you're invested, you are going to see years where you're earning money. You also might see years, likely, where you might lose money. So you're going to be invested, in the nature of investments is that they sometimes go up and they sometimes go down. The good thing is that over time, more often they move up more than they move down. So it's staying in long over time, staying invested for a long period over time, you're going to see that upward trend of your investments and the return. Now, how much fluctuation you're comfortable with is your risk tolerance, right? If I'm young, I have no need for this money because my retirement isn't for 50 years or 40 years, I might be more aggressive. I might be able to take on more of those fluctuations. The downs in the market don't make me nervous as much because I don't need this money tomorrow. I know that I can stay invested and I can recoup that and I can benefit from the really good years and the really good years will tend to outweigh the bad years. And over time, I can get a really good rate of return on my invested 401k. Now, the investment goals are also a really key component because if I'm really close to retirement, my goal is to retire, let's say in 5 years, I might not want all this fluctuation in my portfolio. So I might not be invested in an aggressive manner. I might be a little more conservative, right? If my retirement goal is to retire in 30 years or 20 years, I have a medium term time horizon. Maybe I'm kind of middle of the road, a moderate investor. So I'm okay with a little bit of fluctuation, but not a lot. And like I said, with the aggressive, maybe you're just fine with all the fluctuation. So your investment goal and that timeline will also help determine how much risk you're willing to take and how you're going to invest that money. Now, almost all 401ks have some kind of tool or person you can contact. So reach out to your 401k provider and say, hey, I want to find out what the right mix should be for me. Sometimes there's really good questionnaires or just having that conversation with an advisor. If you don't have something like that, definitely feel free to reach out to me. I do this all the time. I help people just understand what the investments are in their 401k. I'm happy to do it, but most likely there's something in your 401k, either using a tool that's in your login or having a conversation with that advisor just to say, hey, how should I invest this? What makes most sense for me in your specific situation? All right. Now, an important part of the 401k, and I get this asked all the time, especially if you're starting, is what happens if I leave my company? Well, your 401k is completely portable. And also, so you can take it with you when you leave. So for instance, let's just imagine my current employer has a 401k, I'm investing it. And I say, you know what? I have a good opportunity at another company or just whatever makes sense. I change that employer. If they have another 401k, I can actually roll this over into that 401k. It's completely portable. There's no tax complications by doing a direct rollover. I can simply just move this money into that 401k. It's very simple. If you move into a company that doesn't have a 401k, you can actually set up your own IRA account, and your individual retirement account, your IRA, will act very similar to your 401k, except it's not associated with any employer. So you can take your 401k balance and you can roll it over into your IRA. You can keep it invested and you can maintain the tax deferred growth. You can even continue to contribute to that and grow it. So you have options. It's completely portable. And if you do a direct rollover, you'll never see tax implications from doing that direct rollover. Now, so one thing I want to talk about is kind of vesting. So oftentimes your 401k plan will have vesting schedules. So the first part of your contributions, right? Anything you put in is always your money. So anything, let's just say that I deduct out of my paycheck that goes in, that's my money. If I leave tomorrow, that comes with me. Anything on the employer contribution side, though, that may have a vesting schedule, and every 401k is going to be a little bit different. Some may have it, some may not, and also some may have different vesting schedules. But a vesting schedule says, look, for any contributions that the employer has made, you have to be with the company for a certain time period before that money, the employer contribution, becomes available to you. So it might be, let's just say, a 3-year period. And year one, 30% of the employer contribution, like the match, would be available to you if you left. And then year two, maybe 60% or 66% would be available to you if you left. And after year three, all of it's going to be available if you leave. So the different vesting schedules that may apply to your 401k are only attributed to the employer contributions. Your money, anything that you put in on your own, that's all your money, and that's completely portable at all times. Once that money on the employer contribution side is vested, that money becomes yours as well. If you ever were to leave, not only do you get your money and you can roll it over, but any employer contributions that are vested can also move over. So it's really important to understand those two key components. So essentially, that's what I got for you guys. That's how your 401k looks. Now, in the event that you guys don't have a 401k available at your employer, there's a couple different state plans that may be available. It's not a 401k, but those do have some types of different investment options. They also have tax benefits. For instance, I'm in California. We have what's called the Cal Savers Plan. It's a little bit different than a 401k, but it's essentially the same thing. It's a retirement savings plan. You can put money in and you can save it. You can grow it. And in retirement, you can utilize it for whatever expenses you need. Other states might have different plans, but if you don't have any of those plans available to you, there are different options to kind of take advantage of the tax deferred growth. One thing to look at is an IRA. I was mentioning that as a rollover option, but you don't have to just roll it over. You can simply just start your IRA on your own and you can start contributing. It wouldn't come out of your paycheck. This would be what you need to do, kind of setting up your monthly deposit or writing a check every month. But you can set up your own IRA. It does have the similar tax benefits, and you can also utilize that in addition to your 401k or separately from your 401k to save for retirement. So you guys, I hope that this was all really helpful. Now, my info is here, so you're more than welcome to get in touch with me anytime. If you have questions or if I kind of covered things that were unclear for you or specific situations, most definitely go out into your 401k plan, ask them those questions. You're more than welcome to use any of the tools or calculators at Bankrate. They have quite a few different options. And then of course, feel free to ask me if you can't find your options elsewhere. I'm here for you guys too. Do we have any questions?
I guess one question that people could potentially be thinking about is, does does having your 401k, like once it's distributed, once you're taking money from it, does it affect Social Security income once they start collecting their Social Security?
Oh, that's a great question. So your Social Security will be taxable in portion or in whole, depending on how much money you take or how much income you have in a given year in retirement. That threshold's really high. So for most people taking reasonable amount of retirement income, the answer will be no. There's not a big difference. Only a fraction of your Social Security usually is taxable. And unless you start taking a lot of money or have a lot of income in those retirement years, will you get pushed up into that next threshold? Another question similar to that might be Medicare. And that is also maybe a little bit tighter of a window. So if you do take as a married couple $190,000 of income or earn $190,000 of income in retirement, either from your 401ks or from Social Security, that could bump you up into a higher IRMA for Part B and your Part D drug plan. So there are some considerations when you're taking money because that will add to your taxable income, and Social Security taxability is related to income as well as the Medicare IRMA. So there are some considerations, but those numbers are pretty high up there. So unless you're taking a lot of money and earning a lot of money in retirement, for the most part, the answer is no.
Okay, perfect. Well, Jason, thank you so much for all the great information and just kind of breaking it all down for everyone. Again, if
Absolutely.
anybody has questions, you are more than welcome to reach out to Jason. We'll have his contact info, I believe, posted with the webinar on YouTube. And again, thank you to everyone for attending. And if you're watching the playback, thank you for watching. And we welcome all feedback. So again, just any feedback is greatly appreciated. Just remember, Intermission was created for you with you in mind. Thank you, everyone.
Thank you, guys.